Welcome back to the Money Pig Podcast, brought to you by Goodwin Investment Advisory, where our mission is to lead people to financial peace, independence, and generosity. I'm your host, Reed Trigo, joined again by certified financial planner Justin Pitcock from Goodwin Investment Advisory. Hey, Justin.
Hey, thanks for having me.
Oh, yeah, it's always good to have you here. I appreciate you taking the time to join us.
Yeah, man.
Good. Well, today we want to talk about we've been through so many topics here, but the key factors that influence stock market performance during presidential election years. You wanted to talk about this. You're all excited.
This is a hot topic because we get asked this all the time by our clients. So everybody's like, man, the elections really, really bother me. Should we cash out? No.
Yeah. Oh, no.
The answer is no.
Okay. Well, then we're going to record an episode that you can just send it to your clients.
There we go. This is
same answer over and over. Yeah, I can't wait. So before we do that, though, Justin, you and I have differences of opinion on the Social Security situation. You could read the bottom of your Social Security statement and see that in 2034, they're only going to be able to pay like 78% of the promised benefits. And I'm of this age.
But we agree it's a Ponzi scheme. And they can just adjust the formula, and they will. It's been around since the 1930s.
You have so much faith. Here's the deal. I decided this. You're right. I think that they will do something to maintain it. I just don't think it'll be good for America as a financial entity.
Good for America now?
No. Well,
I mean, if you're drawing a Social Security benefit,
and then it's good for you.
But how much, if you'd taken that same money and saved it yourself, how much better would your financial situation be versus letting the government try to provide a benefit for you based on money they force you to save and put into the system?
And that they took out of your paycheck and promised to give you back, except they spent it on something else.
And then they tax you on your Social Security benefit, money that you already earned.
Yeah.
And pay tax.
Yes, it's a bad deal. It's a bad deal until you get to the age where you can kind of see it over the hill and you start thinking, well, that'll be a nice supplement.
It's a huge piece of most people's retirement. So it's a key piece. Could it have been better? Yes.
Oh.
Could it get better? Well, it comes with a cost, right?
Yeah.
So
I always thought, I remember being in my 30s and thinking, you know what? We have the greatest generation. Those are my grandparents. And you know what? I'm like 20 years removed from my 30s now, but I remember thinking we should be the next greatest generation. You were in your teens at this time, Justin. And if I had any influence at all in the world, I would have said, we're the next greatest generation. You know what we're going to do?
We're going to Social Security.
Yeah. We're going to commit to save X percent, 10% of our own income and opt out of Social Security and not be a drain on society when we get to 65.
Man, I don't know. Maybe that's coming.
Well,
it didn't happen for your generation.
Yeah, too late for me. You should do it. Okay. All right. So that was an example of something we disagree about, and because I'm a little bit alarmist. And again, I'm not a conspiracy theorist, but I dabble. I just like to know what people think out there. But here's the deal. I don't really think this is conspiracy stuff. This is not related to the election yet. Hold on. But I started listening to the All In podcast. Now, this is the #1 podcast on Apple right now.
Really?
Yes.
It's not the gigantic. Money Pig?
Well, behind the Money Pig. No, it's not. We'd like to think so, but we're not. So, but these guys are like 4, I think, billionaires. They're politically diverse. They're like all Republicans, conservatives, not all liberals or Democrats. They just decided that they can have conversations and still be friends.
Yeah.
Okay.
How much are they paying you for this advertisement?
Well, it's very interesting, and it's the #1 podcast. I've only listened to a few episodes because Tim got me hooked on it. So I was like, okay, I got to check this out. I know he's a listener. So, but on a recent episode, they were talking about this sham, the house of cards that is the United States economy right now. And I want to tell you why. Okay,
let's go.
Because first quarter of 2024, GDP growth was 1.3%. And by the way, at the end of the first quarter, it was said it was 1.6, revised down. Okay. It always is, right?
No, it's always revised. It's not necessarily
usually down.
I don't have the stats on it, but I do know they'll revise it up from time to time.
We're going to keep paying attention. Okay. It's true. Unemployment, all that kind of stuff. Yes, it revises up. And they're just saying that is such a paltry growth number. Now, end of quarter 2 of 2024 looks like it might be 3.1%. Okay, that's fine. But all indications are with the yield curve going from inverted to, if it starts to flatten out, it'll be the first time, if we don't have a recession, it'll be the first time we've not had a recession in that scenario ever. True?
I believe so.
Yes, that's true. And this economy, let's say 1.3%, 3.1, whatever, is totally propped up by government excess spending. They've pumped dollars, stimulus dollars, into an already healthy economy.
Oh, yeah. I mean,
the definition of Bidenomics, just objectively.
Yep.
And so that's pumping it up. And then you consider that GDP is a large part of it is consumer spending. Like 70% of it is.
Yep. That's right.
I'm being validated here. I love this. Smartest guy in the room is validating me. And consumer credit card debt is at an all-time high. It was at an all-time high before the pandemic, shut everything down. People got their credit cards under control. But here we go. Give them a bunch of money, give them a little freedom, and they've now spiked it. So all of this growth, I'm afraid, is based on federal spending, excess spending and debt, and personal excess spending and debt. Agree, disagree, or want to fight?
Let's fight.
We're going to fight. Here we go.
Now, I'm not prepared for this conversation.
I know. So I didn't want you to have too much ammo.
I don't have the data here, but
okay.
You got to think about what income is, and that's risen. And that's part of the reason why we keep having inflations, because incomes increase, spending ability increases. If your income increases, then you can borrow more, right?
Mm-hmm.
So, it would make sense as an economy grows that debt levels in nominal terms are going to increase because the economy as a whole can borrow more money. So that's a logical argument. I don't have any stats here. I wasn't prepared for this.
It's okay.
But
I do.
It's always going to keep going up because as the economy grows, maybe not always. If the economy contracts significantly, then nominally the debt numbers are going to come down. And inflation, in inflation-adjusted terms, erodes debt.
Yeah.
So let's just think, if your income's increased over the past 2 years, has your mortgage increased? Not unless you moved. You didn't refinance to a higher rate.
Okay.
So your debt is a larger percentage of your income now relative to what it was a few years ago.
Inflation adjusted.
Yeah.
Yep. Okay.
And your mortgage didn't change. It's fixed.
Right.
Now, credit cards are variable. But
yeah.
the point is, inflation helps an economy's debt go away. Generally, as long as incomes go up in proportion with inflation, that can actually be healthy long-term for the economy because that fixed debt becomes a smaller and smaller percentage of an individual's income or a business's income.
Okay.
On the Q1 GDP, that's always or generally that's the lowest growth quarter of the year. Q1 is almost always, it's going to be the lowest growth quarter.
Well, everybody's paying off their credit cards.
From Christmas.
Yeah. The Visa and Amex do fine.
We live in the northern hemisphere. The weather's normally the worst during the first quarter. People don't get out when it's, cold and rainy, snowy, whatever. So, in parts of the country, like you can't even build during those months. So it's like, the economy really does slow down in the first quarter.
Awesome.
That's a reoccurring trend.
Okay. Yep. Beautiful, beautiful. Let me just hit one more thing on this economics thing. And I don't want to scare people. I'm just telling you, literally, if we come out of this yield curve situation without a recession, it would be a miracle of some sorts. Who knows what that recession means? The other part of the conversation I think is interesting is, we measure the health of the economy based on gross domestic product and production. Maybe we really should measure it more on how individuals really are being affected or really feel, because that's why we're looking at this economy right now, I think, in an election year, and they're trying to tout good economic numbers, low unemployment, good growth, but Americans don't feel it. And I want to give you an example why.
Okay, let's go.
It's called the Mickey D's economy.
Okay.
Okay. McDonald's price increases. We should link this in our show notes.
All right. This is the real measure of inflation, right?
Here's why it is. 96% of Americans eat at McDonald's once a year.
Okay.
8% eat at McDonald's once a week.
Once a week?
Once a week. Almost 1 in 10. It is the most ubiquitous product in the American economy. It affects the most people.
My stomach hurts just thinking about it.
I actually love their French fries. Okay.
Their chicken sandwich has gotten a lot better, though. It's almost as good as chicken fillet.
You're a connoisseur. I remember a few years ago, the reason I would swing through there for a small fry and a large unsweet tea, because the unsweet tea was $1 in the summers, and they would make it higher in the winter, but I didn't go there in the winter. I went in the summer. So anyway, here you go. At the end of 2019, medium French fries, $1.79.
Okay.
Can you tell me what it is middle of 2024? Do you know?
I don't go there for the fries. I go for the chicken sandwich.
$4.19, 134% increase in 5 years. McChicken. Oh, here's your sandwich.
All right.
Was $1.29 at the end of 2019.
Dang. Okay.
$3.89.
What?
$3.89.
I thought it was more than that.
201% increase.
Yeah, that's nuts.
No, it is. It's crazy. 10 McNuggets from $4.49 to $7.58. Cheeseburger, $1 to $3.15.
Well, this could be a whole nother podcast now.
I know.
The CPI is a lie. There's these substitutes and all this. It's nuts. You might want to cook a steak dinner, but the CPI is like the consumer price index. They're like, oh, well, you don't need a steak. You could have a pork chop instead. Hence, there's no inflation. Are you kidding me? The steak's 3 times more than it used to be.
That's right. It's not like the sticky items like home insurance and rent. Those things
insurance is going way up. There's huge rate increases across the board right now. Yeah,
I know. But this McDonald's economy, it just shows us. Imagine how that's affected. And then I polled my friends earlier today. I said, okay, 8 of us. And I said, when's the last time you ate at McDonald's? A, this week. B, in the last month. C, in the last year. D, can't remember. And I got 5 Ds, 1 A, 1 B, 1 C.
Okay.
So, and the A who ate there this week said if I hadn't gone through there while I was traveling on Saturday I went through on breakfast, it would have been D. I would not remember the last time I went.
Okay.
So out of that's 6. Is that 6? Out of 8 of us cannot remember the last time we went there. Now, here's what I want to tell you. None of us are blue collar. This is a relatively middle to upper income group. So I'm arguing that this McDonald's price increase has just devastated just as an example, not the McDonald's itself, but has really, really crushed the middle and lower income
who would
folks
eat there
who
more
eat there
often,
more
theoretically.
often. Mm-hmm.
Interesting. Yeah. Agreed. I mean, when you think about the percentage of your spending on food or gas, it's going to be a different percentage depending on where you fall on this, in the kind of the economic social class, right? So, for lower income folks, it's a much larger percentage of their income that goes to food. Yeah. And there's a lot of inflation there, right? But for higher income folks, that's still a small portion of their, of what they spend their money on. So their disposable income. So that makes a lot of sense.
Yeah. It is this K-shaped economy, right? The middle and up are actually performing really well. The middle and down are having a really hard time. They're going down. But anyway, that's an economic, I don't want to be like a bummer, but pile up cash, folks.
We're going to talk about not piling up cash here in just a second. I've got some stats for you, Reed.
I thought I had the perfect setup. Okay, so let's talk about the stock market in presidential years. What say you?
We get asked that all the time. Should I invest differently? Should I do anything different because it's an election year? Should I pull out of the market? And the answer is no, no, and no. Because the stats show that election years, depending on the time period you're looking at, are basically average or even above average. And again, it depends on the time period. Some time periods show a slightly below average. Some show a little above average. Or it's just think of it as it's going to be, or the odds are it's going to be an average year.
So you're saying if that guy gets elected, he's not going to destroy the world. tomorrow.
It doesn't matter. Okay. What it really boils down to is the economy growing or is it contracting? Is the Fed going to lower rates? Or are they going to increase rates? Those are the two major factors that determine what's the stock market going to do.
Absolutely.
What's the economy going to do?
Economy and the Fed with interest rates. So overall, we believe that investment decisions should be based on longer term fundamentals, not near term political outcomes.
Yeah, you should always be invested based on your goals. And whether you're Republican, Democrat, you'll be, and history has shown this, significantly better off by staying invested, regardless of who's president, regardless of who's controlling Congress. It doesn't matter. There's good examples and bad examples of both, but it's tied. It's due to the economy. What was the economy doing before that person got elected? What was the Fed doing before that person got elected? That's what's going to determine the course over the next few years.
So we're going to talk about that, but my argument goes back to House of Cards.
The House of Cards. Well,
maybe.
So go think back on the economy and consumer spending, right? Is that what you're saying is the House of Cards?
Yeah, that the growth of our economy, the health of our economy, without the federal spending in excess and building debt, and without the personal debt being at an all-time high. If everybody just had the balance, where would we be? Boom, negative for sure.
Well,
I would offset easily 3%.
Corporate earnings have not been like up across the board. And so when you think about economic growth, manufacturing's been in a recession, but service businesses have actually been growing over the last couple of years. I mean, I don't know exactly the number of months that manufacturing's been contracting, but it's been, I believe, over a year, maybe a year and a half or something like that. So recession or not recession, manufacturing's been in a recession. But the service side of things has made up for it. And the reason the S&P 500's done so well over the last year and a half, almost 2 years, is thanks to a small handful of companies.
FANG and NVIDIA.
Yes.
That's it.
So, but if you didn't own those companies, your portfolio wouldn't have done very well. In fact, you might have negative returns over the last couple of years because you didn't have that 5 or 6 stocks in your portfolio. So that's another reason why if you buy the whole market, like an index fund, you capture those 5 or 6 that are carrying the whole market. You still would have enjoyed a really good rate of return over the last couple of years.
Yeah, I was looking at an S&P 500 index fund that I hold, and I was like, yeah, those top 5, those are performers right there.
That's the power. It's
I had NVIDIA.
Market cap weighted index.
Yeah.
And so it's, as the winners keep growing. I mean, that's why it does so well year over year.
Yeah. So here's a stat regarding specifically elections. Okay. Since the S&P 500, S&P was established in 1926, there have been 23 election years, federal presidential election years. And in those 23 years, in 19 of them, that's 83%, 19 out of 23 presidential election years, the markets, S&P had a positive return.
Yep.
That's pretty interesting. And here you go. When a Democrat was in office and a new Democrat was elected, the total return for the year averaged 11%. When a Democrat was in office and a Republican was elected, total return for the year averaged 12.9%. I don't know what that means. It just is.
It's up.
Yes, that's right. You make 10%. Okay, 10, 11, 12%. Great.
Yep. So, yeah, I would be less concerned about who becomes president than, what is the economy growing or is it contracting? Is the Fed going to lower rates next or are they going to increase rates next? That's what's ultimately going to matter. I've got some stats on that too. You want me to go ahead and share those?
Yeah, do them. That's interesting.
So think about where the economy is. The Fed has been raising rates. They've paused that. I can't remember the last rate hike.
July
last year.
2023.
Yep. So yeah, it's been about a year. We're in this hold period. So some stats on what has the market done during the 6 months before the last hike. Okay, so thinking earlier in 2023.
Okay, January 2023.
The stock market's averaged close to 7. The bond market's averaged close to 2.
Not in 2023, but across all the times you've had these interest rate hikes. Okay.
Yep. So this is, I'm trying to look at the time period here. I have to get back to you on that. The average rate of return during the hold period for stocks has been little over 21. Bonds has been almost 15%.
15% on bonds.
15% on bonds. And people right now, they've been burned in bonds during 2022. They don't, I mean, I can tell you just that from talking to clients, people generally don't want to invest in bonds. But bonds during the hold period have had their highest rate of return than any other period of time during the Fed cycle. This is the best time to enter bonds.
Before a hike or before a
before a cut.
Before an interest rate cut.
You want to enter into the bond market during this hold period. That's where we appear to be right now. I mean, we don't have a crystal ball and know for sure, but all indicators say the Fed is going to cut rates, and it's widely expected they're going to cut rates before the end of the year.
Because the speculators are looking at it going, I think rates are going down for these price of bonds. My bond is more valuable. I could sell it right now because the new bonds available are going to have a lower rate.
In the future, new bond issues are going to have a lower rate.
Yeah, and those are the speculators. But they apparently are making up a lot of the market.
I mean, I don't know that it's
really.
It's trying to price in all the relevant data.
Okay.
And so I don't know that it's like a speculator, day trader, that sort of thing.
Yeah,
it's
not day
trying
trader.
to price in the data that's available.
Okay.
So bonds have had a great rate of return. It says the average for cash is a little over 5%. That's exactly where we are today.
Yep.
People are like, Justin, why should I take money out of money market or a CD and invest in the market? I'm earning 5%. I'm like, well, the average rate of return during the whole period for the stock market's a little over 21. The average for the bond market has almost been 15. The 6 months after the first rate cut for stocks has been about 14.5. For bonds has been close to 7. For cash, just barely above 4.
4. Mm-hmm.
So how are you going to feel if you're holding on to that money market and those CDs and, think it 6 months down the road, 12 months down the road, your 5% rate of return now, it's like, oh, you're only earning 4, or maybe it's 4.25, whatever it is, 4.5. And then the Fed cuts rates again. And meanwhile, you missed out on this rate of return of the stock markets. It's up 30, 40% over this time you were trying to hold on to cash because you thought 5% was good. And then cash isn't attractive anymore because now it's only paying you 4, or maybe it's paying you less than that. And you want to go into the stock market because the stock market feels safe because it's been doing well lately. Trust me, that's not when the stock market's safe. That's when it's the most risky, when it's near an all-time high.
Awesome. Let me just make a clarification there, because you're not arguing that people that have money for short-term projects saved in a high-yield interest account at 5% should, I'm going to build a deck in a couple months. I probably should throw that in the market because I'll make 21% in the next month.
No. This is for invest based on your long-term goals.
Long-term, not the short-term savings need to be short-term savings. They'll need to be cash-wise.
Yes, thanks for that clarification. That's all. You always need to invest based on your goal.
Good.
and let that drive how you're invested, and not try to time the market around the election, not try to time the market around the Fed. It's timing the market, not timing the market.
Yes, I love it.
I guess the bottom line is interest rates, the growth of the economy are going to impact your portfolio way more than the election. And the point I'm trying to make is that this is a good time to invest. And if you've got a lot of cash on the sidelines, I don't know that I would just buy in all at once. We talk about dollar cost averaging, gradually getting in, and we like to do it systematically because next time there's a 5 or 10% pullback in the market, which will probably happen because it is an election year, and the volatility will happen. You're going to be, scared potentially to buy in, right? And that's the best time to buy in.
Let me just define dollar cost averaging for the people, because that is taking the same amount of dollars and systematically on whatever schedule you choose, it might be weekly, monthly, every other weekly, whatever, something like that, putting them in the market and investing them, because then if the market is high, you're buying fewer shares with those same dollars. When the market is down, you actually get kind of excited. I'm buying right now. I'm buying more shares when it's down. Yeah,
that's right.
So you just systematically, same amount of money every X period of time.
So we like to do it systematically because the investor behavior behind it feels better to invest when the market's up. And it feels scarier to invest when it's down, but actually when the market's down, it's less risky because the odds are that it's not going to go down, as much as it it's because it's already pulled back.
Yeah. Do you run into people who are like, hey, the market's way down. Should I stop contributing to my
Oh,
401k?
yeah. It happens all the time. I'm like, no, it's on sale. This is the best time to buy.
You have a 20-year horizon.
Yeah. It's like, this is a gift. You're not retired right now. You're not withdrawing from the portfolio. You're buying.
Tell me about that.
So, one other stat, regardless of, Republican, Democrat, time in the market matters. So if you had $1,000 in January 1 of 1926 and invested that money, by the end of 2023, that $1,000 would have grown to be $14,567,541. Did I say that right?
Yeah, I think you did.
Okay. Point being,
$14 million.
$14,567,541. Just starting with $1,000.
That's never adding more money to it.
Never adding another dollar to it. That is with dividends reinvested. So it's time in the market, not timing the market. And so trying to change your investment strategy based on who you think the president's going to be it's been a losing game, and suggest you don't try it.
Awesome. That is brilliant. So, and just to summarize it, we hit a couple of these already, but key factors that influence stock market performance during presidential election years: economic conditions, which we covered.
Yes.
Which I've clearly outlined why we're going through a recession.
I think the data shows that parts of the economy have been in a recession, that there's actually more upside. I think that expectations can beat to the upside. Mm-hmm. And that's a good point to bring up, because the stock market and the real economy are different.
Totally different. You can be in a recession and have a good stock market.
That's right.
That's right.
And the reason is the stock market is forward-looking what the prediction is for the real economy. And it's making growth assumptions for 6, 12, 18 months out in the future. So even if the economy starts going into a recession, stock market's saying, oh, the Fed's going to lower rates. There's going to be this new growth that's going to happen. Maybe it's in 6, 12, or even 18 months, and the stock market can actually take off in anticipation of a rate cut when the economy slows. So,
that's right. We ought to do another episode sometime about what the economic cycle actually is.
Oh, yeah.
The names of all the different stages and everything. Okay, we'll come back to that sometime. Other things the other factors that...
So the actual growth, the Fed.
That's right.
Yep.
Market volatility affects what the stock market's going to look like. There's no real conclusive evidence that there's more or less. You can read 100 different things and it'll say, yeah, it's more volatile by 1%. And you read something else and say it's less volatile by 1% during an election year.
It depends on the time period. And so I've grown to expect a bit of volatility during election years, but it's short term. One day it could be down. Think back to when Trump got elected the first time. Well, the first time.
He's only been elected once, Justin.
Yeah, thanks, Reed. But overnight, stock market futures dropped 10%. Mm-hmm. I mean, the market panicked. So the market futures, so you can generally trade in the market between 9 and 4 or 9:30 and 4. Well, the futures, you can still trade market futures throughout the night, basically. Mm-hmm. And the futures just plummeted and then rebounded the next day, whipsawed. All those folks that were selling out of the market totally got it handed to them.
Markets hate surprises, and that was a surprise.
Yeah.
Happened late at night. Yeah. Another thing that can affect market performance in election year is policy expectations. What do you really think something's going to happen? But that's expectations. Do people really adjust their market? Hopefully not. Investing behavior based on what policy expectations are. I suppose there are some circumstances where we would say yes.
That's a great point. The data shows that trying to position your portfolio based on policy expectations is you've got poor odds, really poor odds, because even though politicians may talk about doing this or that, the follow-throughs normally not there. Maybe it doesn't have the same effects.
Or it's muted.
Right. Yeah. The same effects that you anticipated. And, so kind of to the same lines there, think of two things come to mind really between Biden and Trump. Mm-hmm. So, for the Trump supporters that, they're like, it's going to help the economy. I can think of one area where if Trump gets elected, that this is an area that probably won't do good. It's because, like, we know Trump has a track record of, pro drilling, like, let's get gas prices down. So that's great for us as consumers. That's not actually great for the energy companies. That crunches their margins. So when, there's more competition, oil prices go down, their profitability goes down, their stock prices go down.
Our 401ks go down.
Well, so if you're invested in energy, but it's that area is probably not going to do great based on that. But then again, data shows trying to make that bet right now is not a wise thing to do. Mm-mm. If Biden gets reelected, he's hard. He's anti-guns, and he wants to regulate all the guns and all of that. So one would think, well, let's not own any gun stocks. But actually, that produces fear. It causes consumers to want to buy more guns while they can. It increases demand, and so gun manufacturers can charge more for their products. Their stock prices go up. So it's a little counterintuitive, but there's just like one example of kind of the extremes of how one area would do good or bad depending on the candidate, and it's not always exactly what you'd think it would be. Yeah,
that's amazing. So since we're on the election right now, did you hear Trump's recent proposal that he was in Las Vegas or something, and he proposed hospitality workers not having their tips taxed?
I didn't hear that.
I know that probably went him some points. But you know what is funny? I was in college when they started taxing tips. Or maybe they were always supposed to. I don't know. But yeah, it used to be just cash free. Like somebody paid on a credit card, gave you a $2 tip. They took $2 out of the till, and you took that $2 home at night, and you were never charged taxes on it. It was somewhere right around the early 90s, I feel like, that they started having to report a certain amount of taxes being taken out of tips.
Perhaps you weren't doing your tax return right, Reed.
Well, that's possible.
I don't know for sure. But
check it out, though. I think that they were tax free.
Okay.
I could be wrong. I'm not an accountant. Well, I never even took accounting.
You've done well for yourself, though.
Well, it's because I got help. Let's say hypothetically you were my advisor. It's not hypothetical.
Speaking for a friend.
Yeah, exactly. I'm asking for a friend. Oh, my gosh. All right. Well, good topic and fun. Talking to you,
This was great.
Yep. And as financial advisors, I always like to remind you that we manage and rebalance portfolios and do our best to create really good portfolios, hopefully that outperform the market, which means maybe make a little more, lose a little less.
Been kicking butt.
Yeah, you've been really good lately. That's really good, and I appreciate it for one. But the unique value is that we work to understand our clients' individual goals so that we can have these types of planning conversations that are so personal and unique to each individual. So thanks again, Justin, for being with us.
This was fun.
Yep. Hey, thanks for listening. And hey, click subscribe, like, follow wherever you're listening to this podcast so you don't miss the next episode. Talk to you next time. Bye.
The Money Pick podcast is hosted by Reed Trigo, a financial advisor at Goodwin Investment Advisory. This podcast is intended to share information and perspectives, but should not be interpreted as legal, financial, or tax advice. The opinions shared by participants are not necessarily endorsed by the company. Goodwin Investment Advisory is regulated by the SEC, and the company operates in compliance with applicable securities laws and regulations.